Welcome to this lesson on basic elements of accounting information. I'm CPA Paul Gaido. Kindly remember to subscribe to this channel, Treatise of Accounting Information Systems. There are 6 elements of accounting information. 3 shows the financial position of an entity, while the other 3 shows the financial performance of the entity. Assets, liabilities, and equity shows the financial position of an entity, hence are reported on the balance sheet. On the other hand, revenues, expenses, and dividends show financial performance of an entity and hence are presented in an income statement. An asset is any resource with a monetary value that is either owned or controlled by an entity as a result of past events and has the ability to provide future economic benefits or has service potential to the entity. Assets can be classified based on either the duration held, the physical existence, or based on the use. When assets are classified based on the duration held, they are categorized as either non-current asset or current asset. Non-current assets are assets that are expected to last in an entity's balance sheet for more than one accounting period. Current assets, on the other hand, are assets that are expected to last in an entity's balance sheet for less than one financial year. When assets are classified based on the physical existence, they are categorized as either tangible asset, intangible asset, or fictitious assets. Tangible assets are assets with physical existence that can be seen, touched, or felt. Intangible assets are assets that exist without a physical form. For instance, computer softwares and goodwill. And lastly, fictitious assets are imaginary assets that do not exist and do not have any physical form. For instance, deferred expenses. Lastly, when assets are classified based on the use, they are categorized as either operating asset or non-operating asset. Operating assets are assets that are essential in business operations, such as cash, receivables, inventories, property, plant, and equipment. On the other hand, non-operating assets are assets that are not essential in day-to-day business operation, such as investment in subsidiaries and investment properties. Non-current assets are assets expected to last in an entity's balance sheet for more than one accounting period. They comprise of property, plant, and equipment, investment property, intangible asset, financial and investment asset, biological asset, prepaid operating lease rental, and development project in progress. Current assets are assets expected to last in an entity's balance sheet for less than one accounting period. They comprise of inventory, cash and cash equivalents, accounts receivable, prepayment, and non-current asset held for sale and discontinued operation. Inventory comprises of raw materials for production, work in progress under production, finished goods, and consumables such as stationery. Cash and cash equivalent comprises of cash in hand, cash in transit, cash at bank, and short-term investments. Account receivables comprises of trade receivables, other receivables, and accrued revenues. Lastly, prepayments comprises of expenses paid in advance, outstanding interest, and contract assets such as project mobilization deposits. Fictitious assets are imaginary assets or expenses presented on a balance sheet. They are assets that do not have a physical form, do not exist, cannot be seen, and cannot be felt. Examples of fictitious assets are preliminary expenses, accumulated losses, deferred tax assets, underwriting commission on issue of shares, discounts on issue of shares, and loss on redemption of shares. Both intangible assets and fictitious assets do not have a physical form. However, they are not the same. Intangible assets exist in an intangible form, that is, they do not have a physical form that can be seen or felt. On the other hand, fictitious assets do not exist. They are just deferred expenses or imaginary assets presented on the balance sheet. Intangible assets can be realized, that is, they can be sold to a third party. On the other hand, fictitious assets cannot be realized, that is, they cannot be converted into money. Acquired goodwill and computer softwares are the most common intangible assets. They exist but do not have a physical form. They can also be realized and converted into money. Deferred tax assets, accumulated losses, and discount on issue of shares do not exist. They do not have a physical form and cannot be sold to a third party. Liabilities. A liability is a probable future sacrifice of economic benefits arising from present obligation of a particular entity to transfer assets or provide services to other entities in future as a result of past transactions or events. A liability is a financial obligation of an entity to the third parties. It is the claim of outsiders to the total assets of an entity. A liability arises due to past event or past transaction of an entity that include but not limited to borrowing, promise to pay later, accepting refundable deposits, receiving conditional grants, entering into contractual agreements, and legal obligation to pay. Borrowings is an agreed upon obligation to receive an economic resource from third party now that will be repaid back at a future date, such as bank loans. Promise to pay or deferred payment. An entity may defer payment by making a promise to pay for an obligation at a later date, such as post-employment benefit set aside for future payment. Refundable deposits. An entity may require its customers to make deposit as a pledge to fulfill certain requirements. Once the requirements are fulfilled, the entity either refunds the deposit or offsets it with receivables. Such deposits include caution money and meter deposits. Conditional grants. An entity may receive grants and donations from a third party with conditions on how to utilize them. The unutilized grants are a liability to the entity. Such grants include government grants. Contractual agreements. An entity may enter into contractual agreements that give rise to financial obligation whether billed or not. Such contractual obligations are accrued expenses or contract liabilities. Lastly, legal obligation to pay. A legal obligation to pay arises due to statutory and regulatory requirement to make payment. Such payments include payment to government as taxes, licenses, and fees, payments to third parties such as insurance claim by insurance firms, and court ruling against the entity. Liabilities can be broadly classified into three, that is, long-term liabilities, short-term liabilities, and contingent liabilities. Long-term liabilities are liabilities that are repayable after one accounting period. Short-term liabilities are liabilities that are repayable within one accounting period. Contingent liabilities are liabilities that may or may not arise depending on the outcome of uncertain future events, such as court ruling. Long-term liabilities comprises of borrowed capital, refundable deposits, grants and fiduciary funds, and deferred payments. Borrowed capital comprises of long-term loans and mortgages, finance lease, hire purchase and installment purchase, and bonds and debentures. Refundable deposits comprises of customers' deposits such as caution money, rent deposit, and meter deposit, non-withdrawable deposits such as SACCO savings, and returnable container deposits such as soda bottles and crates deposit. Grants and funds may include general fund, special purpose fund, investment fund, and fiduciary fund. Deferred payments are promises to pay at a future date. Long-term deferred payments include deferred tax liability, post-employment benefits such as service gratuities, and unclaimed financial assets such as unclaimed dividends. Short-term liabilities are liabilities that are repayable within one accounting period. They include bank overdrafts, accounts payables, accrued expenses, proposed dividends, deferred revenue, contract liability, taxes payable, and outstanding claims. Bank overdraft is a line of credit offered by banks to withdraw or spend more than you have in the bank account. Accounts payable are paid in bills invoiced to an entity for goods supplied, services received, or works completed. Accrued expenses are expenses incurred but not yet billed. Proposed dividends are dividends declared by directors but are yet to be paid to the shareholders since they are awaiting approval. Deferred revenue is the amount received in advance for an obligation that is yet to be performed by the entity. Contract liability is the amount due for an obligation to be performed in future, such as project mobilization deposit and pro forma invoices. Tax payable are taxes computed but are yet to be paid, especially when the due date is at a future date. Lastly, outstanding claims. A claim is a demand for payment for a specific right or obligation. Any claim that is pending is called outstanding claim. A contingent liability is a potential liability that may occur depending on the outcome of a future uncertain event. Some of the uncertain events that may give rise to contingent liabilities are legal suits in a court of law, product warranty, pending investigations, credit guarantees, loyalty points, and accumulated compensated absences, that is, outstanding leave days. Equity is owner's capital in an entity. It is the total net worth of owners in an entity. Equity is the claim of owners to the total asset of an entity. It is what remains to the owners after all assets are liquidated and all liabilities have been paid off. Equity can be broadly classified into three, that is, paid-in capital, retained earnings, and gained capital. Paid-in capital is capital that has been introduced into an entity by its owners. It comprises of subscribed capital, issued share capital, and share premium. Subscribed capital is the amount of capital that has been contributed directly by the owners into an entity. Subscribed capital include proprietors' capital, partners' capital account, and share application account, that is, shares that have been applied but not allotted. Issued share capital is the total amount for shares that have been allotted and paid up. Share premium is the total amount issued above the par value of shares. Retained earnings are profits that have been retained by an entity for growth. It's comprised of general reserves, specific reserves, and free reserves. General reserves are profits retained by an entity without a specific purpose. Specific reserves are profit retained by an entity with a specific purpose, such as capital redemption reserves. Free reserves are profits that are retained by an entity, but the entity is free to distribute them as dividend at a later period. Gained capital are other capital reserves that were neither introduced by owners nor part of retained earnings, but are gained and built by an entity over the period of time. Gained capital include revaluation reserve, donated capital, and currency translation reserve. Revaluation reserve is a capital reserve maintained by an entity to record gains on an current asset that arises due to changes in market value over the time. Donated capital reserve is an account used to recognize capital gain when an entity receives an uncurrent asset as a gift or unconditional grant or donation. Lastly, currency translation reserve are capital gains that arises due to an entity translating the financial reports of its subsidiaries from the functional currency into the reporting currency. Currency translation gains and losses result due to the varying exchange rates over the time. Paid-up capital is classified based on the nature of the accounting entity. For instance, in sole proprietorship, paid-up capital is referred to as owner's capital. In partnership, paid-up capital is classified as either partner's capital account or partner's current account. In companies, paid-up capital is classified as either subscribed capital, such as share application, or issued capital, such as share capital and share premium. In cooperatives, paid-up capital is classified as members' capital. In non-profit-making organization, paid-up capital is referred to as accumulated fund. And in government and government agencies, paid-up capital is referred to as consolidated fund. Revenue is gross inflow of cash, receivables, or any other consideration arising in the course of ordinary activities of an entity. Revenue is income generated by an entity from either sale of goods, provision of services, rendering of contracted works, or returns from savings, investment, and right of use. Revenue is broadly classified into two, that is, operating revenue and non-operating revenue. Operating revenue is revenue generated from the principal business activity of an entity. For instance, a trading company generates sales revenue as operating revenue. Non-operating revenue is any other revenue that is earned from other activities of an entity. For instance, gain on disposal of assets. In public sector accounting, revenue is classified as either revenue from exchange transactions or revenue from non-exchange transactions. Revenue from exchange transactions is income earned by an entity after giving out something of approximately equal value. For instance, sale of goods, provision of services, rendering of works, or returns from investment. On the other hand, revenue from non-exchange transaction is income received from another entity without directly giving it approximately equal value in exchange. For instance, taxes paid, fines and penalties. IFRS 15 provides a 5-step model for recognizing revenues from contracts with customers. That is, step 1, identify the contract with a customer. Step 2, identify the separate performance obligation in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to performance obligations in the contract. And lastly, recognize revenue when or as the entity satisfies a performance obligation. Expenses. An expense is the cost incurred by an entity in order to either generate revenue or to derive utility, and from which no further benefit is expected. For instance, electricity, rent expenses, and salaries and wages. There are 5 types of expenses. That is, production cost, cost of sales, operating cost, financing cost, taxation cost. Production cost is cost incurred in manufacturing of goods. It is cost that can be directly traced to finished goods. Cost of sales is cost associated in generating operating revenues. It is cost of producing or acquiring goods sold. Operating costs or operating expenses are cost of running business operation on a day-to-day basis. Financial costs are cost of borrowed funds, that is, cost of debts, and cost of handling money. Lastly, taxation cost is the mandatory payment to government and its agencies without expecting to receive equal value. Production cost is cost incurred in manufacturing of goods. It is cost that can be directly traced to finished goods. Production cost comprises of direct materials, direct labor, direct expenses, and production overhead. Direct materials are raw materials used in production. Direct labor is wages paid to production workers. Direct expenses are royalties paid for right of use. And production overheads are other expenses incurred in production department. Cost of sale is cost associated in generating operating revenues. It is normally cost of either acquiring or producing goods that have been sold. Operating costs or operating expenses are cost of running business operation on a day-to-day basis. Operating expenses comprises of governance cost, employees cost, administrative cost, marketing and distribution cost, and provisions and contingencies. Governance costs are costs associated to shareholders and directors. Employees costs are costs associated to staff of an entity. Marketing and distribution costs are costs of delivering goods and services to the market. And administrative costs are other costs of running the business. Financial costs are cost of borrowed funds and cost of handling money. It comprises of interest expenses, bank charges, and foreign exchange losses. Taxation is the mandatory payment to the government and its agencies without expecting to receive an equal value. Taxation cost in an entity comprises of licenses and fees, corporate taxes, and deferred taxes. The last element of an accounting information is drawings and dividends. Drawings and dividends are withdrawals and distributions to the owners of an accounting entity. Drawings is the amount of economic resources withdrawn by the owner from an entity for personal use. On the other hand, dividends are the distribution of profits by an accounting entity to its shareholders. Normally, drawings are in sole proprietorship and partnership, while dividends are in corporations with large number of shareholders. Normally, drawings are done by taking cash, asset, or goods from an entity or entity incurring personal expenditure on behalf of owners. On the other hand, distribution of dividends is done through payment of cash dividends, issue of bonus shares, distribution of assets to shareholders, and sharing of profits by partners. Thanks for watching. Remember to subscribe our channel, Treatise of Accounting Information Systems. Like this video, leave a comment, and share with others.